Well, yeah, so welcome to everyone in today's show. Very choppy day yesterday. I hope you all fared well. I'm going to talk a bit about that, obviously, in a bit of detail in a moment. First, let's just crack on through the bits and pieces that have happened overnight. I'm going to take a look at a bit of the data first, where I make sure I get the right stuff up. So some data out from China and Japan overnight. Well, first of all, Kuroda, he was saying that CPI expectations for next year are going to stay below 2%, which means they're going to keep on easing. Now, obviously, the market's looking at what's happening in Japan. As we saw yesterday, we saw some numbers out, PPI numbers out, still coming in hot. Inflation is on the rise over there, up at 2.8, 2.9%, I think. So they are above target, and the issue is going to be how long does it stay above target, and will that force the Bank of Japan into changing? But he's keeping the same line. They're going to keep easing, and that's one of the reasons why we continue to see a bid in dollar yen and it moving up and up and up, because there is no change from them. But coming back to the data, we had China CPI out overnight, and that was up year on year, 2.8%, matching expectations, but still confirming a jump on the month. But a little bit of softness in PPI. So the manufacturing side, input side, was up at only 0.9%, missing expectations, lower than the prior month. Again, year on year numbers. So perhaps a little bit of, Stelia spoke about PPI, its importance earlier this week. Maybe things are a bit more messy over there, obviously, with all the lockdowns and everything that they put in place, various industries shutting down to conserve power for population use. So the numbers there are a little bit messy. But again, overall, here we have a country easing into potentially higher inflation, which is obviously not how the rule book works, but that's what's happening in China. Then we've got a bit of CPI data and some wholesale prices from Germany, a rise there year on year, month on month as well. CPI in France and Spain coming in a bit lower, 5.6% versus 5.9 prior on the CPI. Same on the Eurozone measure, 6.2 versus 6.6 year on year. Spain as well, a little bit softer, 8.9 versus 10.5 prior CPI. Again, pretty much exactly the same in the Eurozone measure. So a bit of softness creeping in to Eurozone prices, but we're seeing this with many other countries as well. As we saw yesterday, US CPI, headline CPI softer, UK CPI has come in softer last month. So a lot of people may look at this and think, oh, well, we've got a peak in inflation. That may be the case. It may just be a little bit of a blow off the top. So no one's going to get too excited about what's happening there until we see some decent trend developing. And that's something, again, I'm going to point out in when we talk about the US CPI numbers from yesterday. So we had Biden out talking after the inflation report yesterday, saying inflation is his top priority. He is still worried about gasoline prices, even though they've moved down, and they're a big factor, particularly in consumer expectations for inflation. He's going to speak more on that next week, apparently, so maybe some more measures to come from that. On the geopolitical front, and this, I think, had a bit of a big influence yesterday, but maybe a bit missed by a few markets or a few people. Certainly, I only saw the headline and just glossed over it. This was picked up by Paul 88 in our chat room. And this was Russia's Lavrov in an article announcing the readiness to consider a signal from the US to start a dialogue over Ukraine and everything else that's going on. Now, this does follow several comments we've had out of Russia. They've been a bit flaky, mainly been about talking about talks or potentially having negotiations, whatever. Now, the recent lines have been, I think Lavrov issued one early in this week where he said, yeah, we're open for talks, but the US's willingness to talk is all lies. So it's all been a bit flaky, this stuff. But this Lavrov headline sounded, in essence, a bit more conciliatory. And I think that's been maybe a big part of the risk rally that we saw yesterday, on top of everything else that was going on. Now, I read the article itself, and while he said they're open, they're ready to sit down and talk, they're not going to chase the US for talks. So they're not going to be banging on the US door to say, right, we're ready to talk. They're putting it in the ball in the US's court. So take that as you will. They tend to speak out of both sides of their mouth. But I do think it had some influence in what we saw yesterday in the rallies in the pound, the euro, Aussie, you name it, the bounces there, risk in general, that might have been a factor. So we've been monitoring these headlines. We'll keep a further eye on those. Over to the ECB. Now, amid all the CPI stuff, there was some headlines out about a new ECB staff model. Now, the ECB staffers are the ones that produce the forecasts and so on, and they're very important to the decisions the ECB makes. So apparently there was some new staff model which saw the terminal level for the deposit rate, so the maximum the ECB rates may get to, of the deposit rate of 2.25%. Now that would put the main rate at 2.75%. From where we are now, that's another 150 basis points of hikes all round. Now that's getting it to a terminal rate. That's very low compared to, well, rates at other countries around the world. The Fed are, are currently in the 3%, looking for a terminal rate 4 or 5%. The UK in the same boat. So this would mark a very low terminal rate, which will put the neutral rate potentially quite well under it. Now that's possibly lower than what the market might be expecting. We're not seeing too much of that effect or that news in the euro at the moment, but when it comes down to the final point where the US stops and the ECB stop, there's still going to be a huge divergence in there if they stop at 2.75 in their main rate and the US is up at 5%. So that's something that potentially is going to come out at the next ECB meeting. If the market doesn't like it, then certainly that may contain any upside for the euro going forward. Now, speaking of the October meeting for the ECB, we've had another round of BODs out. Simkus saying he favours 75 pips in OCT and 50 in DEC. Kestrel Kazakhs 75 in OCT and then go another big step in December. Casimir 75 in OCT. So these guys, it looks like 75's nailed on for the next meeting. The discussion will be what they do into the end of the year. But again, it's all going to revolve around where they see the terminal and neutral rates coming in. Into the UK. Oh, here we go. Here's the tough stuff. Right, we've had this on-off U-turn headlines pinging around all afternoon yesterday and all morning about whether they're going to reverse some of the mini budget. They're looking at potentially a U-turn in not raising the corporate tax. That was Truss's plan. Now they might reverse that to actually raise the corporate taxes in there. We're seeing the pound shift around a bit on that, but there's a bit more influence from the dollar today. So whereas yesterday I was happy to trade the headlines because they were coming, the pound was moving, everything else was pretty much taking the afternoon off until the CPI data. It was a bit more easy to trade. There's a bit more dollar influence today, so I'm not really touching these headlines. But if we do get a turnaround, we could see the pound rising a bit further. Over to the BOE. This is their last day for their gilt operation. Now, yesterday they bought 3.12 billion in the index-linked bonds versus just under 2 billion the day before. In the long-term gilts, they bought 1.56 billion versus 2.37 billion the day before. What they've announced today is that they are relaxing the limits basically for the last day's bond ops, and they're going to assess how many offers they get at 11 a.m. Their limits at the moment are 5 billion for each one, 5 billion for the linkers, 5 billion for the gilts, but they're saying they're going to relax that, and they all, in their words, they're going to reserve judgment over the limits they place on that. It's basically a last call to say, okay, if people need to do more in this final rush, then they're not going to say no to it. So keep an eye on the numbers there. If it's big numbers again today in both, then I think potentially we have further issues to come after they stop the program. If it's fairly small numbers, less than what we've seen or round about what we've seen, then potentially we're over the hump. But Monday is still going to be important to see how the pension markets and everything else reacts once there's no Bank of England backstop. So keep an eye on those numbers there. It could be a big mover for the quid later. Right, so that's the headline stuff. And before I get into the CPI stuff, oh, sorry, yeah, there was one other thing. Back to geopolitics. The US is reportedly going to take part in a nuclear exercise, which has been said is unrelated to Russia. So make of that what you will. The nuclear talk is never far from the front pages. Stel, before we get into the CPI, you got anything you want to add to anything today?
Well, once again, you've said pretty much everything. One thing I just want to add a comment regarding Lavrov's comments and you know, the situation in Ukraine. We have to remind ourselves that waging war in winter is a lot tougher, right? And we've seen reports that the Russian army is starting to feel the effects of such a prolonged military operation. And there's videos, there's obviously we're not there to know ourselves, but it does look like the army is getting tired and they're enlisting more and more people who really shouldn't be fighting. But anyway, and just wanted to note that as the Russian winter comes, it's going to get a lot harder to engage in warfare. So I think there's an added, and they know that, right? So there's an added incentive to, if they are going to go the route of diplomacy and trying to find the solution, I think the time is getting quite closer now because of that as well.
No, but, I think a valid point. But do you think there might be a situation where they enter into talks and drag it out through the winter? And then, to get them over that period, and then after winter, turn around and say, "Oh well, talks are falling through. We're back to military action."
Yes, of course, there's a possibility of that, and a pretty high one as well, I would say. So, with everything, we have to take everything with a pinch of salt. And but I think, and I've said it before, I think we're getting a lot closer to a positive headline from that front, and that's definitely going to be very, very good for markets, at least in the short term. So we have to be wary of that. Every day you are, I've been saying it for a while that my macro bias is still unchanged. I think rallies should be sold in risk because, the environment is not changing. But to be short risk, you're running basically every day. You're short an option of such a headline coming up and just ripping your face off. So, you have to be aware of the risks. Depending on the position.
Yeah, and just to play devil's advocate and throw in a counter view, it's just as much winter, obviously, for the Ukraine and Europe, and Russia still has the keys to the gas taps. While it may hurt them on the military side, they've still got that on their side to pressure the Ukraine and the West with. So, yeah, there's always two sides to the story, as we say. Right, so let's get into the CPI, or maybe just before that, just look at those jobless claim numbers. A little bit of a tick up in the numbers there. Obviously, the Fed are looking for weakness to come into the jobs market. So maybe we've got signs of seeing something there. I always look at the 4-week average when taking a wider view of that. We've had a little bit of up and down in it at the moment. But if we start to see a real growing trend, then we're getting closer to maybe seeing some weaker NFP reports, and perhaps some changing themes in the jobs market. But for now, a little bit of an uptick, but it's nothing of note. Right, so straight to the CPI. Now, what actually happened? Because the market's obviously made a lot of it. We've obviously seen big price moves, but let's just boil it down to what actually happened. What actually happened was that CPI fell for the third month on the row. Okay, so the fact it beat expectations for me is largely irrelevant. This was the third lowest number on the trot. Now, to counter that, we saw a fairly significant jump in the core number, beating expectations, up 3 pips. That's for the second month in the row it's gained. So put it all together, we're potentially seeing a lower trend in headline inflation, but the core is still rising. As I pointed out yesterday on that chart, the core tends to lag the CPI. So it could be that the core is going to catch up with CPI, or it's going to turn lower in line with what CPI is doing at the moment. Now, CPI isn't dropping significantly. Even though it's the third month on the trot, it's not dropping significantly. So there's no reason for the Fed to change their path at all. Okay, but what is it going to do from here? Now, there's 3 things that can happen. CPI can continue dropping. It may drop faster, it may drop slower, doesn't matter, it continues dropping. We've got a lower trend coming into play. And if the core maybe has another couple of months of staying where it is, and then it starts following the CPI headline, then we can probably assume that the Fed is going to stay their path to terminal rate 4 to 5%. That's going to be the top. Then we start thinking, what next? How long they're going to have to hold rates up there for? How long will they hold rates up there for before they start maybe bringing them down? The second option is that CPI turns around and carries on up. That means the core is unlikely to drop and more likely to increase.
Ryan,
yeah, go on,
sorry to interrupt. There's a headline: UK's trust to reverse some economic plans later Friday. Bloomberg. So
Bloomberg?
There you go. Yeah, and thank you, Gavin.
Yeah,
sorry,
cheers, Gavin.
carry on.
No, we've had this all morning. I said this morning, these UK will they, won't they headlines are worse than an OPEC meeting. You know, when we get all the crap before an OPEC meeting. So Bloomberg's pumped that. Let's see if in 5 minutes time we get someone from the government coming out, as they have all morning, saying there's going to be no change. On and off these headlines drive me bonkers today. But anyway, back to the CPI. So the other option is that CPI gains and the core catches up, or we see CPI maybe moving in a bit of a range, maybe somewhere between 7 to 9%, and the core comes up and then sits going along, moderating and going sideways a bit. Now, for the last 2 options, that's potentially more hawkish for the Fed, because it means if inflation doesn't drop, if inflation stays up or goes higher, it means their policies at the moment aren't working. They're hiking rates hard and fast. It's not having an impact. That's going to push us into a scenario where the market's going to say, well, what happens now? You're hiking rates. Does this mean rates are going to go up? Where are they going to go up to? 6, 7, 8%? You know, they're going to question the credibility of the Fed again to contain this. And so that's going to potentially, if we get into that situation where inflation isn't dropping, where the Fed are having to turn even more hawkish than they are now, then we're potentially heading for a shit hit the fan moment. Because if you think yields are a problem now, yields going up to 5, 6, 7, 8% is going to be a problem. The dollar going up even further than it is now is going to become even more of a big an issue for other countries than it is now. So the market has taken this and it's gone a bit bonkers again. Right after the CPI report, we've got the market pricing in 100 BP hikes again. That got to 10% probabilities yesterday. It was at 11.3% chance this morning. So the market is again getting a bit hawkish. We also had our mate Timmy Leaks, Nick Timiraos from the Wall Street Journal, the supposed Fed whisperer, saying that CPI has cemented a 75 pip hike at the next meeting. So maybe drawing down some of those 100 pip expectations. But for me, what I see a trend low in the headline CPI, and the core maybe a bit more to do. But if the trend continues in CPI, core will likely turn as well. But if this is just a temporary dip, then I don't dare guess what's going to happen to expectations, yields, and the dollar thereafter. So what we've seen yesterday might just be the tip of the iceberg. Now, Stel, do you want to have a quick view of your view of the CPI before we get into the price moves over it?
Yeah. Well, the market initially clearly was disappointed because it was higher than expectations. But like you said, it's a few low readings on the trot. In the grand scheme of things, we're talking about 0.1 here and there. You know, unfortunately, the situation is that CPI is still sticky, and I've said for a while I think that it's really going to start dropping early 2023, probably February, March. When we are then going to be comparing year on year with a big jump that happened this year. So so for now, I think the market's trying to find reasons to be happy about CPI, about anything that has to do with inflation, but it's just not getting it yet. And yes, yesterday's move was insane, down from down 2.5% to or 2% to up 2.5% on the S&P. I mean, that's just a massive daily move, but I still don't see what's different. And yes, the CPI was 0.1 lower than last print, but really in the grand scheme of things, this is not enough, at least not now, for the Fed to be to be changing their course. So I still remain of the opinion that risk should be sold, rallies should be sold. And yesterday's big rally, I think we reached some pretty, well, I mean, we'll have a look at those later, but we reached some important levels in the S&P, and I think my bias remains the same. I know I'm boring by saying this all the time, but it does.
Yeah, no, I agree with you. I mean, we had, there was some in the press were saying that large buy programs were triggered when the dollar reversed the gains, and that impacted the S&P. There was a lot of machine-driven buying. And these programs can sometimes kick in and they just buy, and it's a one-way street.
Yes.
But we did get a funky move in dollar yen right on the CPI as well. We got this move here, a big blow off, some 100 odd pips just instantly. And that actually came in during during the morning edge. I popped on the morning edge and it happened right there and then. And a lot of people obviously said, well, that's intervention. But to me, it didn't look like intervention. It wasn't big enough. If the officials in Japan are going to intervene, you're going to see 200-300 pip moves, not a 100 pip move. So it's likely either a bit of a fat finger, or at most maybe someone pulled Suzuki out of his bed or out of the pub, and there was a little bit of a phone around the banks. But a lot of people, the first instinct was, oh, they've intervened on that move, and I don't think they did. Now, what was interesting is that we held up right bang on the 1998 high. We just broke it now, and there has been a headline out from Kishida just this moment ago. He says sharp FX volatility involving speculative moves are undesirable. Now, I don't know if that's a general comment or he's seeing speculative moves now. He is PM, but it's going to be his MOF guys who are going to decide if we are seeing speculative moves, and we've had a few of them out. And as far as I can tell, none of them have mentioned that anything they're seeing right now is speculative. As we know from the last intervention, that was a big part of why they intervened, because they saw the move up as speculative. Right. So as we've seen, a lot of choppy moves yesterday. Euro dollar all the way down, all the way up. The same for the pound. A lot of these moves. And I want to speak about trading such things, because I saw in our chat room You know, a few people getting caught offside. But I don't want to come across as a know-it-all after the event, you know, condescending, telling you what you should have done, and making out like I'm the big professional who knows what to do. It's more a case of how you plan going into these events. Now, it's very difficult. We've all been caught offside. I've been caught in these things. We've all been caught in these things. You're not expecting such volatility, but you end up getting it, and you get caught in the middle, and you try to train around it, and you just get spanked either way. So there's two things you can do in this instance. Now, I spoke about this yesterday, how I set up for these big events. I don't care about the first 50, 100 pips that happens over these things. I look for where the price may go and where it might run into trouble if there is a big move. I believe I mentioned yesterday, look at the 98 level. If we get up there, that's an area you need to look at, not 97.5, 97s. It's all noise. And that's what I tend to do going into events. Okay, I ignore anything within 100, 150 pip range, and I pick my levels outside of that. Now, those levels can still get blown up, but those are the areas I'm going to place my risk against. And if they blow up and I lose money, then I look to the next area. And if I'm happy to trade the next area, fine. That's how I approach all these big data events, all these central banks, NFPs, whatever. Just that's the way I am. That's the way I set up. I try and keep myself out of the noise where possible. And what I look for is when you get a sharp move, okay, you get a move like that, what happens after? Now, if it rallies all the way up, again, I'm going to ignore it. But if it stays here, if we get another test down near that level and it holds maybe a few pips above, 10, 20 pips above, and I see a hold, well, that gives me something to trade on, because, you know, I can lean against this prior low, for example. Say the price bounced up to 96.70, then came down to 96.40, and we moved around there a bit. As long as it didn't challenge that low, that's something I'm going to look to trade, because the market's saying, right, we had that low. At the moment, it doesn't want to go lower. But I understand that people, you know, they look at the levels in between, they see a run, they want to see a dip, so they get this, see a rally, think, right, well, the news is still bad, I'm going to sell that rally, and, you know, they get caught on the other side. It is very difficult. I understand that. But what I want to try and say is, you know, if you get this big volatility, your only job is to protect your account. Okay, if the volatility is too big, if you have a couple of trades that don't work, pull yourself out, sit back. Don't be you're not a JP Morgan tanker in a storm. You're a retail trader on a Lilo in a storm. Don't get in the water. Sit on the sidelines. Let it all do its thing. See what happens after. And, you know, another pair I showed yesterday, dollar CAD. You know, been trading this. I pulled all my offers. I got out my positions. I had a flat book going into that, and look what happened. Big spike through, big volatility. I'm not interested in getting involved in that, because there is a big risk. Now, in this one, I was the right side. If I'd have left my buy stops at 138.60, bang, you know, maybe 100 pips in the green. But the risk was too great for me to do that. I didn't want to get involved in it in the start. But more importantly, look what's happened after. After we've had all this volatility, the levels hold. The levels come into play again. You know, I was speaking about the 137 area. I didn't trade it this morning. I missed it completely. But we had the test yesterday, test again this morning. So the levels after the volatility come back in. We had this mini level in the middle, 137, 50, 60s. Held as resistance, held as resistance. Now we've had a little bit of a breakup. So what you do after we've had all the volatility coming out, you look back at your old levels. Don't care about these levels over the CPI report. I care about them after. Is this 138.50 going to become a level again? Then I can get back to maybe trading it as I was before the CPI. But what's looking like it might happen with a lot of these moves is that they're all coming back, slowly coming back to where they were before it all happened. So even the S&P made a high, huge move, but it's grinding lower. Is it going to get back to here, around the area where it was before the CPI? Who knows? There's a good chance it does. As Estelle says, a lot of people are going to be hitting the rallies, because what's changed? Has anything changed for the S&P compared to where it was yesterday? We've had one CPI report. Doesn't really change anything. The US is still in recession. The US is still heading to further economic problems. Inflation is still an issue. The central bank is still hiking. They're looking to crunch the jobs market. So nothing has changed in the fundamental view to what happened yesterday. So what you have to decide over these events is, did it change it or did it not? For all the volatility, has something changed? For me, it hasn't. But on the flip side, look at something like the pound. You know, we are potentially moving somewhere new. We've had a big move. If we get this U-turn from the UK, could it mean we're heading up further? Could it mean we get up and test this area up in the higher 114s again? It remains to be seen. But in the meantime, if we can't do that, we've gone nowhere. We've had some volatility, we've had some moves up and down, but we're not really going anywhere new yet. And so that's the exercise you have to do before these things and the exercise you have to do after these things. What's changed? If nothing's changed, well, you've got to think we're going to stick to the ranges. And, you know, Aussie dollar's another one. You know, I was looking at this one, this 62, 40, 50 area. Will it hold? Will it become a decent support area? Well, over the CPI report, no, it didn't. It went all the way through 62s, all the way down there. But now we're back above. We've moved back above. You draw the lines in the sand again. You know, this bit of a pivotal area, 62.70. Will it hold if we get a move down here? We're 18 pips away. If it doesn't, will it then hold down at this 40.50 area? If it doesn't, well, then where are we going? Are we going back down here? But if you start to see it hold here or hold here, then the market's changing a bit. Then you've got a bit of conviction to say, well, maybe the Aussie is basing a bit. But then again, on the flip side, on the upside, I still don't think we break the bearish trend until at least above 64. So while we're below 64, we've every chance of going back here. And these levels will do whatever they want to do. So I hope, you know, please ask questions about this. If you got a few trades offside yesterday and you're wondering what you did wrong or whatever, you know, assess yourself, look at what you did, look at the trades, look at the market moves, look at your levels, see what went wrong, because that's the experience you'll gain to move forward. You know, people talk about Stel, me, K-Man, all having experience. Our experience came from doing exactly what you guys are doing. You win trades, you lose trades. When you lose trades, when you get turned around in the market, you assess and you learn so that the next time, hopefully it doesn't happen, or it doesn't happen as often as it may do before. And that's what experience does. It stops me, it stops Stel, it stops us not making the same mistakes as regularly as we would do 20, 30 years ago. And that's all experience is. So that's what you have to learn. Stel, do you want to add any? I know you've got plenty of wise words of wisdom on this sort of subject.
Well, it is a wide subject, but yeah, I mean, I agree with what you're talking about. You know, about experience, and the main thing is to, as with everything in life, right? Learn from your mistakes, don't repeat them. And I know it's a cliche, but do what feels comfortable. So, you know, I think I've mentioned my example, right? When I used to be a market maker doing like 100 trades a day, huge size in the banks, and then came back here and I was a retail trader effectively, and it just didn't work. You know, my 50 trades a day, you know, way of trading didn't work anymore. So I switched my strategy completely, and I'm now much more a long-term macro-based trader from being a 10-second trader. So do what feels comfortable, and if it doesn't feel comfortable, try to figure out what you need to change. You know, it's as simple as that. But
yeah, I mean, you had a similar case yourself, didn't you? In the S&P, didn't you ever try a little short and then it didn't work? You pull back.
Yeah, got taken out straight away, and then I said, "Yep, enough of that. Take a step back," and didn't touch it again. So, and that will happen. And the main thing is, I know people say it all the time, but it's so difficult. It goes against human nature. You have to make sure your losses are small.
Yeah,
that's number one. make sure your losses are small, because if they don't, then you're going to be out completely pretty soon. So yeah.
Yeah, that's right. You know, you got to respect the conditions you're trading in. So anyway,
Yes.
I hope that's given you guys and girls a bit of advice. I didn't want to come across as a what they call it, hindsight quarterback or day after quarterback, where they call it in the US.
Harry
But
hindsight, we call it in the UK, right?
I don't like seeing people getting turned around in these markets, and I want to try and get you guys and girls on the right lines, so you can learn and not have it happen to you again. But today's another day, and we get back in the ring, as we say, and on we go. And just on that basis, we have got another round of data, which could be pretty big as well. We've got US retail sales, probably not as big as the CPI, but the Fed's going to be looking at that consumer. You know, is the consumer going to be holding up? Is the consumer going to, you know, really start to crater? We know there's a cost of living crisis going on. We know inflation's higher. We know there's a squeeze on incomes. You know, retail sales is one area that's going to be really, really paramount to see what happens.
Yeah. And
now,
also we have to remember that these numbers, they're not inflation adjusted. So you seeing a negative number, it means people are spending less money when things are costing more money by themselves. So you have to, theoretically, you have to see an increase as inflation goes up. It takes, you know, the price of products higher. So if you see like a 0 or a negative number, I mean, it's very bad news, because the average consumer, not only are they slowing down, they're slowing down spending even in the face of rising costs of the goods that are being bought, basically.
Yeah, that's the important point. So what happens with the retail sales number is you'll get whatever we get, and then afterwards you'll get people coming out with the inflation adjusted numbers. Now they have been running negative. If you take, you know, retail sales 0.2%, 0.3%, on a real basis, as Stel just mentioned, they are negative when you take inflation into account. Now, if we get a negative number, that means take inflation into account, it's going to be even more negative. So yeah, it's going to be interesting, these numbers here. You have to wait and see what all the analysts come out with the real numbers afterwards. But look at it on the basis that the market will still move on what the numbers come out as. So if it comes out at plus 1%, the market is initially going to jump on that. What we're looking for here really is volatility in the numbers. You know, they've been running 0.2s, 0.4s, that sort of thing. Not really significant. You know, if it was 0.3 last month and it's 0.2 this month, it's no big deal. If it comes out up 1.5%, that's a bigger deal. If it comes up down 1.5%, 2%, that's a bigger deal. So when looking at these numbers, look at the volatility side of it, if it's a huge variation from there. But as we saw from CPI, it doesn't necessarily take a huge variation to get the market running. But you overall look at this for what it means for the Fed. Is the consumer doing well? Is it not? If it's not doing well, well, that's a tick box potentially for the Fed, because it means then we're going to start to see job losses, but also it's deflationary if people are losing jobs, because if retail sales are dropping, because then you start to get stores cutting prices if they're not making the sales. So it can aid the Fed in their goal. On the other side, for GDP, it's not good news. So it could mean US is heading for a deeper recession. So when you look at these fundamentals, just bear it in mind how it all falls into place with the various different situations ongoing. Whew. I already feel knackered already. Right, so let's get into what happens now. So I've not got much more to add to what I've already said, particularly on the price moves. You know, watch the levels now that you were before the CPI data. Watch them after you see all these volatile moves. For dollar yen, I'm really having to go back in history to, you know, the 80s and 90s just to pull off levels that are potentially going to come into play now. So I'm, you know, looking at the 1998 area, we had that high. It stopped to the pit yesterday, but we've gone through it now, although we are back below at the moment. I've had to go all the way back to sort of this area here, 87s, 90s, just to look at some of the big weekly levels where those tops and those bottoms came in to draw some numbers. For me, it's really coming in around the big figures. So, you know, into 148, into 149, and then obviously, whichever way you cut it, the big 150 is going to be a big, fat, round number, psychological number. A lot of eyes will probably be trading that as an intervention number again. So it's going to be huge. I'm likely, depending on the price action that takes us there, I'm going to continue adding to my short position, still keeping that very small, being very picky on my entries. But up at that 150, I will be trying that for a short-term play on a first test, and to potentially add to my overall core short. But from here, I don't see an awful lot in the tech except around the big figures. If you've got extensions and whatever there, please feel free to throw them up, and we'll have a look at those as well. Gavin's again, trust to hold a press conference later today. Yeah, we've also got apparently Kwarteng flying back, as the press have put it, early from the IMF shindig, to get over to talk about stuff there or get into stuff over here. So we'll see what comes of that later. Mike, no, she's not resigning. And if she does, well, you don't want to be long the pound if she does. Just give me 1 second. Sorry, just had to get the door. Right, just some of the other pairs quickly. Dollar yuan. I did manage to tap this as an after CPI trade. Oh, that's too much. I had a little sell up in this area, 120, 722.50, I think it was, or 80, can't remember. Just to play off the top of these highs that we saw previously when we got up here, the prior high. So I had just a reactionary short in here. Ran it all the way down into the zone. My lowest exit was 617, and as I've seen from this latest price move, I've been stopped on the trailer at 720.50. This one I'm going to be leaving alone for the rest of the day, I think, because we have obviously got the China Party Congress thing starting this weekend, so that's a bit of a risk event going into that one. So I want to see how that turns out, and then make a decision on how to trade it after that, depending on the news. Have you guys and girls got anything else you want to look at? We can look at the S&P, and maybe I'll bring Stel back into this. What do you see the technical picture here at the moment, Stel? Obviously, this 37 level has turned out to be a bit of a resistance area. Do you think we head further south from here, or there's going to be a little bit of indecision?
Good question. I still think, as I said before, rally should be sold. 3,700 is a big level. I mean, last week, the week before, excuse me, I was looking at potentially a rally towards 3,900 to sell at. I think that's the major level for me, and that's probably going to coincide with the 50 DMA. But it's been a level, 3,880 to 3,900 has been a level, an area which has seen some good reaction, and I think that's a very important level to look at. So initially, probably in a smaller scale, let's say 3,700, probably worth trying against that level again. But I have a feeling that that might get taken out, and we head towards 3,900. So I'm going to be looking for 3,900 to short. I'm not going to get FOMO. I want to see how this move continues. But my bias remains the same. Okay, this is a given, and until the central banks tell me otherwise, I am not changing.
Yeah, I mean, technically, you could call that a hold of the fib down there, the 50 fib. So a bit of a significant technical hold there. As Stel says, the upside, the 37, an important level, and as I mentioned earlier, that's been borne out by hitting that high, coming off, then not breaking the high. It's like I said with the other pairs. If you're trading the volatility, look for these types of patterns where you make a move, try again, it doesn't work. That's when you get a bit of conviction that maybe that's the end, and you can try to fade that move, because you don't need to have a huge trade on it. You can have your risk 10, 20 pips, not even that much above, because if it breaks that high, likely it's going higher. That's what I showed in the euro. The same on the downside, it's a bit more difficult. You make the low, then it makes another low, then it makes another low, then it makes another low, then bounces. That's not the price action you want to see. You want to see a low made, then the next candle not as low as that, or the next few candles not as low as that. So in this instance, we got down there, couldn't really break the fib, had a few attempts, got the bounce up from there, it never looked back. So if you're waiting for a dip back down to this level for confirmation, you wouldn't get it. What do? You either try and chase it higher, which, that looks like a good trade when you're sitting here. But if you're only seeing that as you're trading it live, what do? Do you buy it here? You can't tell what's going to happen after. You can only tell what's going to happen at the time. But yeah, so now we've potentially got a range, 35, 37. That's where the market's going to move in. If we get above 37, that's maybe a break to go with. See if it gets up to that 39 level Stell's been talking about. If we can't, then there's a chance we go and test these lows here. So there's your range. That's what you trade in between. You don't need to mess around in the middle. You sit back, have your patience, and look at that. Catherine, can we look at the FTSE? You want a level to get short. Interesting. Any reason for getting short? You just see the UK further imploding. Let's have a look at the FTSE. They're sticking on that daily. So quite clearly, following the same trend that we've got elsewhere in stocks, looks like we've got a bit of a break here. Let's just highlight that. Call it the 68 handle. You've got to always look at the big round numbers, particularly the 7,000 in the FTSE. It's always going to have a say somewhere or another. So we've had this little break. We've come back up. So there's your range. Is it going to hold on into here again? That's where you want to look. We've had a bit of a, let's go here. You've had a bit of a flush through. We're back above, so that's the volatility from yesterday. Bit like I was explaining with the Aussie dollar and that 62.70 and then the 62.50.40. You're looking for an area where it's going to find support. It was support, flushed out on the volatility, back above. What happens when it comes back down here? If this becomes support again, then likely we're going to bounce. You've got your area to long it. Same on the other side. If you're going to look at shorts, do you want to start shorting now? Do you want to mess around in the middle here, or wait for a big old level like the 7,000? If it gets there and holds, well, you've got your reason to short. If it moves above 7,000, you need to reassess. Are you going to be looking up towards maybe the 70, 80s, 70, 70s? So yeah, that's what I would do if I was looking at the FTSE. Pick your levels, see what happens at the price actions at that levels. Right, unless anyone's got any other pairs to look at, throw them up in the chat, or we should call that a day. What a week. Hey, I hope you've all enjoyed yourselves. Please remember to go for a drink. If you haven't already, sign up for the Traders Summit event that's coming up. Let me pop the link in the chat for you. In case you needed any other incentives to come and join, as mentioned before, you can grab yourself, or two lucky people will grab themselves a $250,000 Traders Funding Program account, or I think that's just the assessment to the entry. Is it or the entry to the assessment, Stel, or it's not the full account, is it?
Sorry, no, this is the assessment, right?
So it's not free entry to the assessment, yeah.
Okay, yes, exactly. Usually, these $250,000 accounts cost $2,500, so it's not bad to get it for free.
Yeah, so, exactly.
Yeah.
And there's also a couple of iPhone 14s up for grabs for two lucky viewers as well. So
correct.
If you haven't signed up already, come and join us there. Otherwise, please have a safe rest of the day. Please have a good, relaxing weekend. It's been a volatile one. It's been a volatile month and a bit already. So let off some steam over the weekend, switch the screens off, go and hug the ones you love. Take it easy. Thank you to Stel for coming on the show as well. Take care, everybody. Have a great weekend. See you all bright and breezy on Monday.
Thank you, Ryan. Thank you, everybody, for being here, and get some rest. See you on Monday.
Yeah.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.